Hey everyone, this is Stan Gendlin with Real Estate Skills, and as the owner of Van Rock Holdings, a large multifamily owner and operator in the Carolinas, we're here to talk about multifamily investing. What is multifamily? How to invest in it? How to finance it? What is the difference between single family and multifamily? We're going to talk about all that in this video. And stick around for the end. We're going to give you some secret tips of how to get started right away in multifamily. And make sure you look down into the description, hit the like button, subscribe if you haven't, and we're going to be giving away this free resource of how to get started in multifamily and expert tips. And you could also find all my social media down there to get connected with me. Let's get started. So first, let's talk about what is multifamily. Multifamily is considered any single property, group of properties on a single site where multiple families reside. So that could be as small as a 5-unit apartment complex, which is what banks consider the smallest size for a multifamily property. That could be as big as a 50-story tower where hundreds of families will live. It could also be 50 single-family houses on a single parcel that has only one tax map number, and for purposes of financing, the banks will consider that multifamily as well. It could be a mobile home park. It could be a combination of these different types of real estate. Basically, it's any piece of property or building where multiple families reside. So now that you know what multifamily is and what it's considered, let's talk about the difference in investing in multifamily versus single family. So in a single family property, you have a single tenant paying one payment every single month. That payment is usually used to pay your mortgage, your taxes, your insurance. So if that person doesn't pay for one or multiple months, you might not be able to pay any of your bills. Whereas if you invest in a multifamily property, let's say even the smallest one with 5 paying tenants, if one of them doesn't pay, the other 4 should easily, in most cases, cover your mortgage, your insurance, your taxes. So the risk there is lower. On a single family property, it does take less money to get into that investment. They're usually cheaper than a multifamily property. Whereas a multifamily property will take a larger amount of money to get into it. You will have to renovate multiple units versus just a single unit. And it'll take more time to lease up that property versus just having to find one tenant. And also when it comes to financing, it's a lot easier in cases to finance a single family property. Now the biggest difference in financing single family versus multifamily is the loan itself. So a single family property, you go and get a residential loan just like you would for your own home. Whereas a multifamily property, which again is considered 5 or more units, the bank will give you what's called a commercial loan. In this scenario, the bank is often more concerned about the cash flow and the value of the property and not so much your personal credit situation. Whereas in a single family investment, the bank is heavily looking at your ability to pay that mortgage if this one renter does not. So again, in a multifamily property, the bank is looking at the ability of the property to pay the bill, versus single family, the bank is looking at the ability of you to pay that bill. Also, in single family, it can be a lot easier to manage because you do only have to deal with one person. If you find a good renter in your property and they're paying your bill, they're not calling you all the time for all kinds of maintenance issue, it could be a very easy investment for you. Whereas on the other side, with a multifamily property, if you decide to manage it yourself, you have 5 or more people that will be constantly calling you if you don't have professional property management. So it could be a lot harder to manage. Another big difference in single family versus multifamily, if you increase your rent on a single family property, in most cases, the value of the property does not change. Because the value of single family properties is based on the market value of similar type homes. Whereas in multifamily, the value of the multifamily is based on the income it produces. So by increasing a rent on a property for as little as $25, let's say, you're increasing it $25 across multiple units, which increases the value of the property by quite a bit. So you have the ability to increase the value of your property on a multifamily by proper management versus a single family where only renovations and improvement to the property can increase the value, but you're still limited by the neighborhood and the area you live in. And whether you're investing in single family or multifamily, you should consider using professional property management. Not only does it allow you to oftentimes get more rent with less headaches, but you can often lean on the experience of these professional property managers to increase your rents and know how to screen tenants properly so you don't get people that will not pay or beat up your units. Also, in single family versus multifamily, there's a lot of tax benefits to multifamily. Multifamily properties have a lot more things that you can depreciate, meaning you can take it as a loss on your taxes to reduce your taxes at the end of the year. So there's a lot more tax benefits that can be had with a multifamily investment if that's what you're looking for. Sometimes single family properties can produce more cash flow on a per door basis, but tax benefit wise, you will always get more with a multifamily property. So those are some of the biggest differences in single family versus multifamily investing. Now let's move on to tips for investing in multifamily real estate. Number one, when you find a property, whether it's through a broker or a seller to buy, these people want to make sure you can actually buy the property. So if you have the cash, make sure you prepare some sort of cash flow statement showing you actually have the cash on hand to buy the property. If you're going to be using a loan, go find a lender that's ready to give you the money, analyze the property that you're going to bring them, and give you a loan. These are things that sellers and brokers want to see before they'll even do business with you, especially if you're just getting started. One of the best ways to start getting leads in multifamily without spending a lot of money is start calling brokers. A lot of times brokers are coming in and out of the business all the time. So there's always an opportunity to build a relationship with an ambitious broker that will bring you a lot of deals. Usually when starting to work with a commercial real estate broker who will bring you these multifamily real estate deals, they want to see that you know what you're doing. So you need to learn and understand how to analyze a multifamily property. One of the best tips that I got when I first got started was when brokers would send you deals, and often they would send you deals that just don't make any sense. One of the reasons they're doing that is they want to test you to see if you know how to analyze them and give them the feedback to help them send you what you're actually looking for. So you have to learn to analyze multifamily real estate and know what's a good deal, what's not a good deal before calling out to sellers or brokers, because that's a really easy way to burn relationships. The multifamily investment space has a much smaller pool of brokers that you're going to work with as compared to single family. So remember, a lot of deals are sold without hitting the market. So you have to make sure you build these relationships and nurture them, because it does take time to get these good deals. So starting to build relationships with brokers in that space is one of the first tips I would tell you how to get started right away. Another big tip to get started right away is to have some existing relationships created with a property management company and an inspector before you go looking for deals. A lot of times when you find a good deal, you might have to close relatively quickly. And when you buy these properties, the existing management or staff on the property will not want to stay, and you'll have to take it over right away. So you need to make sure you have a good team of property managers and inspectors ready to do this deal with you. Remember, multifamily real estate, unlike single family, in a lot of ways is a team sport. So you should have a good team of experts with you when you go and start buying these deals. Along with learning how to analyze deals when brokers send them to you, which means things like going through the rent roll, looking at the leases, looking at the expenses of the property, you need to know how to analyze and determine the cash flow and the cap rate on the property. The cap rate is the percentage of return that the property will produce if you bought that property with all cash. So if you bought a property for $1 million, and it produced $100,000 a year in profit, that is a 10% cap rate property. Now, cap rates fluctuate along with interest rates and loans. And just like in single family, there's a lot of ways to finance multifamily deals. Again, remember, those brokers want to see that you know how to bring that deal to the finish line. A lot of times I've been told when I've bought multifamily real estate is the ability to close a loan sometimes is more important than the amount of the offer. So if you can prove to a broker, whether it's through a track record by doing more deals or just having your financials in order, to show them you can actually close the deal, you might actually be able to get a deal that your competitors won't, because you have proven to them you have the ability to bring it to the finish line. Next, let's cover how passive exactly is the income from investing in multifamily real estate. As someone that's been on both sides of that, active and passive, let's talk about the differences. So I have a company that buys multifamily real estate and operates it. Our investors that give us money to buy and operate the properties I would consider are passive investors. We send them monthly reports, we send them their money every quarter. That is all they have to do. They've invested with us, they get all the benefits, the cash, the checks, the tax benefits, and that is all that's expected of them. Versus me being an active operator in multifamily, I have phone calls every single day with my maintenance team, with my property managers. We're talking about strategies to increase rent, why we have so many evictions, what to do about those evictions, how do we get people paid by nonprofits so we don't have to evict them. There's a lot of strategy and a lot of operational day-to-day that goes into being an operator of multifamily real estate. So you could be very passive by investing with a company like ours that buys multifamily, uses investors' money to close on it, and then sends them the reports and the checks. Or you could be sitting in my chair and actually finding the properties, raising money from other people, and then doing all the day-to-day that it takes to operate and make those properties succeed, and then reporting to people that want to be passive. So those are two ways to either be passive or active in multifamily real estate investing. All right, now let's talk about what to look for when buying multifamily property. As someone that buys multifamily on a regular basis, our goal is to buy probably one property every quarter. I'm always researching what to buy, where to buy, how to buy, and all kind of different strategies. Let's talk about the different things that I look for when I'm looking at buying multifamily real estate. So first of all, I want to buy in areas that are growing in jobs. The values of properties are growing, and there's people moving to the area. So one of our strategies is to look for automotive manufacturing growth in different parts of the country. Now, if you're just getting started in real estate, in multifamily or single family, you really should start in your own backyard if you live in an area that's growing and it's conducive to investing. So if you live in a rural area, you might not want to do that. But if you live even in a small town, it's a good idea to start in your own backyard. So the number one most important thing in real estate investing is location, location, location. In areas like the Northeast, where a lot of people commute to work, if the real estate is located near public transportation, that adds a lot to the value. If it's located next to where a factory is going to be built pretty close, and a lot of people are going to want to live close to work, that's going to affect it. If it's located where everyone wants to live, because that's where all the restaurants and bars and nightlife and outdoor parks are, that's also important. So location is the first, second, and third most important thing when it comes to buying multifamily real estate. Now let's talk about the number of units you should look for in multifamily real estate. The first thing you should know about the number of units is that investing in multifamily, when it comes to the volume of units, is like a bell curve. At the beginning, the smallest type of multifamily, 5 units, is probably the easiest to manage. You can probably do it yourself with no management help, no staff, no other type of resources. As that number of units grows, now you're going to need maintenance staff. You're going to need property managers to help you collect rent because it's going to be too much for one person. But once you hit about 100 units, the difficulty starts to curve back down because properties can afford on-site staff to do a lot of the day-to-day, and you won't have to be as involved, and it's easier to manage. So remember, again, the number of units is easier at the front end with only 5, gets harder at about 50, and then gets a lot easier at about 100 units because you can afford that on-site staff. But also you have to consider how much are you looking to buy in terms of price of the multifamily. That will determine how many units you should look for. A lot of areas have a price per door when it comes to multifamily real estate. So you should know if you can invest in a $5 million piece of property and the typical sales price in your area is $100,000 per door, that's a 50 unit maximum property that you should be looking for. You don't want to waste a broker or a seller's time on a property that you can't afford to buy. Finally, when considering the number of units to buy, think about what you want your daily life to look like when investing in multifamily real estate. Do you want to be active or passive? And that's probably the first thing you should consider when looking at the number of units to invest in. Next, let's talk about the potential income of the property. Are you looking to buy a property that's big enough to offset all of your income in one property, and that's kind of going to be your retirement plan? Are you looking for the property to be a springboard to build a multifamily empire, and you need something that can sustain adding some staff to your team? Are you looking to get small investments that you and your family can invest in and kind of offset some of your active income. So the potential income of a property is correlated to how you want to grow your multifamily business. Some people want to buy a property for 5 years, hold it, sell it for a big gain, and that's all they want to do. Some people want to have cash flow for life, so you want to look for properties that are newer, are not going to have a lot of maintenance issues, are in areas that are growing, and you can have a long-term success with this property. So you have to consider, again, what is the purpose of this real estate investment? Next, let's talk about the costs when investing in multifamily real estate and the cost of the properties that you're looking at. There's basically two types of properties when it comes to multifamily real estate investment. There's properties that are pretty stable, don't need a lot of work, and you can kind of operate them, slowly increase rents, maybe add additional types of revenue sources, laundry, pet fees, anything like that. Then there's properties that have been neglected or just need a lot of updating and need a lot of cash infusion to get it up and running. So you're going to have to know that when buying multifamily real estate usually comes with big bills. So one of the things to remember is when you buy a multifamily property, just like with a single family property, usually at closing you get a credit for property taxes as a proration of how long the previous owner has owned it. Let's say you buy a property January 31st, the seller will usually give you a credit for his portion of the taxes from January 1st to January 31st, and then you're expected to pay the taxes for the rest of the year. In some areas, you pay taxes monthly, some quarterly, some annual. But one thing also to remember when it comes to taxes is a lot of times when a property changes hands, the taxes are going to go up dramatically. A current property might have taxes from the previous purchase price that the seller you're buying it from paid. So if you're buying a property for, let's say, $5 million, the person you're buying it from paid $1 million 10 years ago. In a lot of states, his taxes or her taxes will be based on that $1 million purchase price. So when you buy that property for $5 million, they might give you that credit for the month of ownership that they had based on the valuation at $1 million. And when you buy that property for $5 million, your taxes might go up 5 times. So you have to be prepared to pay those taxes at the end of the year and bring that money up front, because usually cash flow will not cover that. As well as taxes, insurance works the same way a lot of times. When you buy a property, your insurance is going to be based on the value of your loan or purchase price. So if you're buying a property for $5 million, as an example, your property insurance, if you're getting a loan for, let's say, $4 or $5 million, will be based on your purchase price. So when you're evaluating these multifamily properties, you cannot use the current owner's insurance cost as your insurance cost in your valuation. Because if they paid $1 million for the property, their insurance policy will be based on that $1 million. So insurance policies and taxes in a lot of states are based on the purchase price of the property. So make sure when you're evaluating or getting ready to buy multifamily, you have a good resource as an insurance agent that can help you come up with a premium for what your insurance costs will be when you buy that property. And in a lot of areas, counties, cities, and states have tax calculators, or you can call the tax office and they will give you an estimate of what those taxes will be so you can prepare to pay them the following year after you buy the property, which is usually when the tax bill gets updated to the new purchase price. Another big expense on these properties is going to be your utility bills. And a lot of times the utility bills have to get paid whether the property is leased or not. Usually there's a minimum fee for some of the utilities. So you have to make sure you have enough set aside to pay the utility bills as well. A lot of times in multifamily properties, the water bill is paid by the owner, and that water bill comes from all the tenants using the water in that building, and it does not get split up by all the various tenants. So one of the tips that you could do when owning a multifamily real estate is doing a chargeback for the water to your tenants to recoup that money. But that is a bill that you will be responsible for when owning that property. Next, let's talk about the other two big costs when owning multifamily property. If you end up getting a mortgage versus paying cash, your mortgage will almost always be your biggest expense, which will have to be paid whether the property is vacant or leased up. So if you're buying a property that has a lot of vacancy and you're planning to do some renovations, increase the rents on them, make sure you bring at least 1 year of mortgage payments, which is what a lot of lenders will require, up front to make sure you can pay the mortgage for a year as you're doing those improvements. The other big cost, if you choose to use professional management, will be property management costs. Now, this can be done a lot of ways. When you're buying smaller properties, usually property management companies will charge you like a flat percentage, 8%, 10%, 6%, depending on your area. Sometimes they'll charge you a flat fee per door, maybe $75 per door, $99 per door. But then they'll also hit you with a lot of different fees, such as lease-up fees, renewal fees, and all kinds of other fees that you should put in your pro forma when you're evaluating these properties. And these are also important questions you should ask when you're evaluating property management companies to hire to manage your multifamily real estate. And in terms of managing larger properties, the typical management fee for property management is going to be payroll plus a percentage. Now, depending on your area, that can vary from 4 to 8%. Now, when it comes to cost, one of the biggest things that's going to impact your daily and monthly costs in a multifamily property is going to be whether you decide to buy stabilized or a value add property. The biggest difference in those is a stabilized property is usually producing income from day one. You're going to pay more for the property, but the property is usually leased up, has been renovating, is in good order, and you're buying a stabilized cash flow producing property. Now, a value add property is a property that has not had their rents increase in a while, the units maybe haven't been renovated in a while, maybe there's a lot of vacancy, there's a lot of other issues in the property, and so you're buying a property that you need to do some work on in order to get it performing. Now, the benefit of that is usually those properties come with a bigger reward at the end, whereas the stabilized properties you're going to end up paying more for, but you get that income day one. I've had value add properties where I didn't expect to make income for years because that's how long it took to redo the whole property and get it properly up and running. So that comes back to what kind of real estate do you want to invest in when it comes to your daily life. When you buy a value add property, you're going to be involved almost daily for sometimes years. Or do you want to be more passive and you're focused on buying stabilized properties? Also, when it comes to value add properties, getting a loan is way harder. You have to bring a lot more money to the table, and a lot more lenders are reluctant to give a loan to a property that's not performing. Next, when you're investing in multifamily real estate, one of the things to look for is working with sellers that have some sort of motivation. So finding sellers, whether you're working directly with a seller or through a broker, brokers know this too. They have plenty of clients that have to sell the property for a number of reasons. The partnership didn't work out. Someone's getting divorced and needs the money. There's a million reasons on why a property is going to be sold in a distressed situation. But they also have a lot of clients that have owned property a long time, created a good amount of equity by increasing rents, and are just selling it at a good, fair price. So finding sellers that have motivation, which is no different than single-family real estate investing, is the key to getting good deals. And again, the key to getting good deals from those sellers is either learning how to market directly to them, building relationships with potential sellers, or building those long-term relationships with brokers that will bring you deals, because most of them will not be listed publicly for sale. So those are the major things to look for when investing in multifamily real estate. So now let's talk about financing small multifamily versus large multifamily. We're going to consider in this video small multifamily less than $10 million and large multifamily over $10 million. When working with smaller multifamily purchases, you can go to your local lender or your regional lender, and they'll give you a pretty decent loan that is a lot easier to get, a lot quicker to get than working with some of the bigger lenders. But again, because of them being a local lender, they're going to give you not the greatest terms, which usually means you have to bring more money to the table and your monthly payment will be higher. Working with these smaller multifamily properties, you still have the option of going to work with some bigger lenders to get the loan. The bigger lenders will look at all of your financials, look at all of your experience. To get the best terms, they want to make sure they're giving money to someone that is not going to mess up the property, make sure it keeps operating, keeps growing, paying all the bills. When you're working with these bigger lenders, there's a lot of compliance they want you to do, filing reports, filing financials, being audited. There's a lot more cost to getting that loan on an annual basis. So you really need to consider the pros and cons of working with bigger lenders versus smaller lenders, and also how much time do you have to buy a property. Usually the big lenders need up to 6 to 9, sometimes over a year to get a loan closed. We closed the loan back in October that took us 9 months to close, where we thought it would take 3 to 4. And this was probably the biggest lender in the United States, which is the federal government. Local banks will be able to close the same type of loan for us in about 30 days, but the terms are going to be nowhere near the same. So those are some of the biggest differences when considering a big lender like the federal government or Freddie Mac or Fannie Mae, which might have better terms, better rates, some better incentives, but will take a long time to close, or going to your local lender, which will be a lot easier to qualify for. You can build that relationship. You can probably get a loan a lot faster, a lot easier with less paperwork, and close much, much quicker, which will make a seller or a broker happy, but you'll usually have to bring a lot more money to the table. Next, let's talk about investing in larger deals using lenders. Usually in these situations, larger multifamily deals are selling at lower cap rates, so lower annual returns based on the purchase price. To make those deals work, you have to get the absolute best terms. And this is where you can use a lot of creative financing to get these deals done. Whether it's using big government lender that'll give you up to 85% of the money you need, or using smaller brokers that will bring you a smaller amount of money, and then you go get an intermediary broker that will bring you 25% of your down payment. Then you have to go raise the other 25%. There's a lot of ways to structure these deals, so let's talk about some of the easier ones. When you're buying large multifamily, the best option you have in terms of how much money they'll give you with the lowest payment is going to be HUD. This is a federal government loan, which is usually for larger properties. It takes a long time to get. Your first one might take 9 months to a year to qualify because of the amount of paperwork with the government. But you're going to get the absolute best rate. You're going to get the absolute highest amount of money. The only downside, I would say, on a loan like that is usually it comes with a 10-year penalty, where if you decide to sell the property or refinance, you'll have to pay some sort of penalty in that 10-year period. After that, stepping down is going to be Freddie Mac and Fannie Mae. These are private companies that'll give you very favorable loans, a little less favorable than the federal government, but also they do take quite a bit of time to get qualified for and to close. Nowhere near as long as the federal government loans, but they do take up to 6 months a lot of times. And a lot of these loans also do come with some pretty heavy penalties for usually 5 to 7 years. After Fannie and Freddie Mac, we'll go to regional lenders. A lot of times these regional lenders only want to lend to really qualified people. So if this is your first time getting a loan on multifamily, they're not going to be a good choice. Whereas a Fannie, Freddie, and HUD usually will care more about the asset and your ability to manage it, where you can bring in a key partner that maybe is not an active part of your business, but just says on paper and kind of oversees the paperwork. They'll be able to give you a loan if you have this key partner in your organization. After your regional banks, this is where you come down to your seller financing, your creative financing, and maybe working with intermediary lenders. One example of this is a property that you're buying that maybe has a lot of heavy value add. The property has a lot of vacancy, needs a lot of work. None of the lenders that I mentioned will usually give you any type of loan for this property. So you have to go to what's called a bridge lender. A bridge lender is someone that's going to give you a short-term loan, usually 2, 3, up to 5 years. You're going to pay interest only on this loan, and they're going to give you a set period of time to get the property turned around, stabilized, and moved up into one of these Fannie, Freddie, or HUD loans. Another deal you can do is maybe doing some seller financing with the owner of the property, We've done deals like that too, where the owner's taken a small down payment from us and given us a set period of time to get the property up and running, get the rents increased, and go take them out with a loan. In some of those cases, the owner said, hey, let me stay on as a partner because I'm selling this property because I'm splitting up from my other partners, but I'd like to stay on and see the benefits at the end. Instead of you paying me $1 million, I'll leave it in the deal and I'll be one of your limited partners in the deal. That's another seller finance way of structuring it. Ultimately, there's a lot of ways to finance multifamily real estate. You need to choose the one that works best for you, the deal, and your business. Now let's talk about managing multifamily properties. There's basically two types of management when it comes to multifamily real estate investing. There's the asset side, and then there's the property management side. Let's talk about the differences. So as someone that owns a lot of real estate, we've had to hire professional property managers. So my job in the company is no longer the property manager. I've become the asset manager. I'm the one that's looking at the decisions when it comes to the financials of the properties, how the properties are performing, when it's time to sell, when it's time to refinance, reporting to your lender, paying the bills when it comes to the lending side, and all the high-level financials of the property. Now, the property manager is the one that's telling us on our team what the rent should be, when we should increase rents. They're the ones doing the evictions, the rent collection, the lease renewals. They're putting together the activities on the property to influence people to come and check out our property, whether it's a barbecue, food trucks, or any other type of activity like that. So you could be an asset manager, a property manager, or both when you're getting started, especially if you're buying bigger properties. Now, smaller properties don't quite need that. If you're buying something under 10 units, 20 units maybe, you can pretty much just have property management and you don't really need a lot of asset management. The bigger you get, the more team members, the more involved you have to be on the asset side as well. But smaller properties, you could pretty much just manage the management company that's actually doing the rent collection and leasing for you. Or in some cases, if you want to be very active, you can manage smaller multifamily properties yourself as well and build out a team just like we did. In either case, whether you're buying big properties or small properties, I highly recommend on your very first one to multiple properties, you hire a professional property manager and learn as much as you can from them and work with them before you decide to take it up by yourself. Now that you've made it to the end of the video, let's talk about the things that I would recommend as I look back on my 14-year career in real estate of what I would do today to get started in multifamily real estate investing. Number one, if you have any money to invest, you should partner with an operator of multifamily real estate. Now, what that looks like, and we do this actively in our business, Van Rock Holdings, we have several investors that will come to us and say, hey, I want to be a real estate investor. I want to be active. I just don't know enough, but I have some money. Can I invest with you in a deal and be included in your meetings with the city when it comes to a development deal? Can I be included in your meetings with the property manager when it comes to looking at the numbers to see if the numbers are working, if they're making sense? Can I just be in all your high-level meetings and learn as much as I can? So the number one tip would be to put yourself in a situation where you're surrounded by experts and are able to learn from them. The easiest way to do that is by giving them money as an investment in their deals. I know many other operators just like us that would be more than happy to include you in those conversations where you can learn so much. Another pro tip that I would recommend that I would do if I were getting started today is learning to wholesale multifamily real estate. Most people don't do that or even think that can be done, but actually it's very possible and happens all the time. We've bought multifamily real estate from wholesalers ourselves. Let's say you find a multifamily property for sale, whether through a broker or more likely a seller if you're going to be doing the wholesale. You would get it under contract, let's say $1 million as an example. Now you're able to find a buyer who's going to pay you $1.5 million for that same property. What you can do in that scenario is say, hey, Mr. Operator or Mrs. Operator, I have this property for $1.5 million that you'd like to buy. How about instead of giving me my wholesale fee, can I contribute it as equity in the deal and become a limited partner? And now I'm part owner of this property, and just like in the previous scenario, I'm asking them, can I be involved in your meetings? Can I be involved in your reviews of financials? Can I be involved in the phone conversations with the banks, the lenders, the insurance companies to learn as much as I can? That is another great way of getting into multifamily real estate investing. Another pro tip that I would recommend that I would do myself would be find operators that are expanding in a city you live or want to work in. When I found myself expanding to North Carolina and buying my first property, I didn't know anyone there. I didn't have any boots on the ground, so we had to drive ourselves. But if I had someone that I trusted, that I knew I could work with, that can go check on the property, that can go unclog a toilet if I needed, I'd be more than happy to compensate them, not only financially, but also with knowledge. So being part of a team of a company that's expanding to an area that you want to invest or you live in, and kind of volunteering or trying to get a job and learning that way would be critical. Knowing the day-to-day operations like that of a multifamily properties is going to skyrocket your knowledge of getting into multifamily real estate. One of the biggest pro tips I can give you, thinking back on my 14-year career in multifamily, is finding high net worth individuals and making that a focus of your daily, monthly life. High net worth individuals and accredited investors, which are people that make $250,000 or more, or $500,000 as a married couple, are going to be the bread and butter of funding your multifamily deals. As you're growing, you're going to have to meet more and more of these people, and you need to just make it a focus of your life to grow this network. And the way I like to do it is through hobbies like boating, golfing, car clubs, anything where someone with a lot of money would like to spend it. In my case, I love going to car events. I'm really into cars. I just joined a car club so I can meet more people, and that is my avenue of finding new high net worth individuals. So I've made it a focus because I'm trying to grow my multifamily business, and we always need capital. So you need to also figure out a way how you can put yourself and your deals in front of high net worth individuals to keep growing that network. That is one of the biggest pro tips I can give you, that you have to make it part of your daily life. So thinking back, those are the 4 most important tips that I would be doing today if I were getting started in multifamily real estate. Thanks everyone for sticking with us through the video. Hope those pro tips help you, and the rest of the information, make sure to check out the description below, get our free resource, connect with us on our website, our social media, and comment down below what else you want us to cover. Happy investing.